What do you think, Chris? I was just breaking down. I think you heard a little bit of my thought process on the S&P 500 and the Nasdaq, calling my hope candles, these big moves up. Are the hope candles going to hold? And if they don't hold, what's the game plan for you? Up or down? What are you doing this week?
Well, I think the key last week was if you were able to survive, Sunday and Monday without having too much damage. And I sat, I sat pretty tight, just kind of letting volatility went from this to this on Monday. And then by the end of the week, we were probably around that. So your implied volatility is still a little bit elevated. I don't think it's out of the sales yet. And this week, I really think that the market is going to be way more employment data sensitive than it is going to be inflation data sensitive. One thing I was surprised to see this morning is I go back to this September, November, December. All this has changed, Nick. September now is back to 50-50. Yeah. It actually, just from this morning, it switched again. Hang on a second. It switched again. Go back to the CME watch tool. So I had it in favor of a 25 basis points cut that just went, yeah, this is different. I should have taken a screenshot, but it was like 52% for a 25 basis points cut. Now it's flipped back, and it's so anyway, clearly the markets are sensitive to the idea of, is the Fed going to cut 50 basis points in September? Is it going to cut 25 basis points? But either way, this is uncharacteristic for the Fed. If we're going to have a cut and a cut and a cut, that's not usually what the Fed does. Right? Usually the Fed is very methodical with like quarterly cuts. If we start a cut cycle, it's usually every quarter. So if we cut 3 times in 4 months and we get to, let's say it's a 50 basis points in September and then a 25 and a 25.
Yep.
I mean, we're cutting 1% and all of next year is going to be roughly 1%. So we do it very aggressively up front. I just wonder if the market is thinking that the Fed's cutting for now recession worries, or if the Fed's still cutting with the transparency of, because it's, inflation is under control, we can be less restrictive. But this is why I think the employment data is now taking the upper hand as far as what the market's going to be paying the most attention to. So this week's inflation, it's Tuesday, Wednesday. Personally, man, I think that Wednesday's CPI, I know we have Tuesday PPI, but I think Wednesday's CPI forecast at 3% is almost high on purpose, because what I'm seeing from the Fed websites is like 2.7, 2.74. I just got filled on my daily. All right, perfect. That was easy profit.
So interesting concept on this, Chris, is, the CPI report. Here's my thought on it. If it comes in low or in line, I think it will just be okay, whatever. I think the tricky part about CPI for me, and this is coming from somebody who is bullish, I think that it has a way more downside risk than it has upside potential, because the CPI, if it comes in hot, you've just introduced a double whammy concern to the market. Now slowing data plus inflation. The market needs to see inflation data coming down soft and easy from here, because now we've introduced a new, it's like when you're watching like Spider-Man 1 and Spider-Man 2 shows up, like it's in the second movie, you got a new villain. You don't want the first movie's villain popping in there too, right? We got a new villain, which is
only in the multiverse.
Yeah, right. Exactly. So my thought process on this is, I was discussing this at the beginning of the show. This concept of rising unemployment rate is now, as you just mentioned, it's taking precedence even over the inflation story, and that's even administered in the Fed's speeches. Powell has been mentioning, we see equal risk now to both sides of our mandate, so on and so forth. The other thing that people often like to mention is that, and I know you and I have talked about this, unemployment rate, when it's rising or falling, it usually doesn't move sideways. Usually it's moving one way or the other. It's usually moving up slowly or down slowly. And in bad situations, it's moving up quickly. So do you think, and this is obviously an economics kind of difficult question, but do you think that the Fed is behind the curve on this? As some, the more bearish crowd would say they're behind the curve, the more bullish would say, no, they've got plenty of ammunition. They can thread the needle. What do you think?
Well, I would personally never give the Fed credit for threading the needle, because usually when they come in, it's something's broken, right?
Yeah.
So I think what the market is interpreting is, if the Fed is cutting rates in September, is it because it's now appropriate to cut rates and they're doing what they said they were going to do all along?
Yeah.
Or is it because oh my gosh, we are in a recession, things are getting way worse. I mean, it's such a delicate situation of what's like the Fed. I do think the Fed is backed into a corner. But what again, we talked about this a lot last week, especially when everyone's shouting for emergency cuts. I'm glad they didn't do that, right? You and I both agree.
Yes.
Like if they start doing emergency
That would have been
slashes,
terrifying.
and so to that point, I also don't want to see. I don't want to see this 50 basis points cut. I don't think they need to do that. I think they just need to do what they say, which is 25 basis points, and just do it for the right reasons. Now, I don't know how much time we have in between. You know, now that we had non-farm payroll, we have unemployment claims every Thursday. We're getting through CPI, PPI this week. The rest of the month, if we can kind of survive
Walmart
with
earnings.
Right, it's gonna be earnings, but they're quiet. Like Mag 7's done. Last week was 1,000+ companies. They're done. This week's only like 300 some companies. And it's mostly China. Like a lot of earnings this week, it's Alibaba, it's JD, it's Tencent Holdings. So it's more China than it is. I mean, obviously the big ones are China, in my opinion.
Yeah.
But going into August, the remainder of the month is like Jackson Hole. That's really all that's left. So I think this is going to be a bit of a grind moving forward.
Did you know that we have 100% free trading tools and data available for you on our website, a1trading.com, right now? We have free courses for you to browse. You can also check out things like retail sentiment and free articles from our analyst Frank that include things like Edgefinder screenshots and trade setups. You can find all of this and so much more for free right now on our website, a1trading.com.
Levels that we're both watching very carefully would be if we come back and test this area right in the middle. Let's just say that the market finds equilibrium, right?
Mm-hmm.
This is now, I'm very short term, and I'll honestly, like, I'm very short term. I think that the bulls, I mean, even this morning, it's like we dropped 35, 40 points this morning, ripped all the way back up. And I was like, okay, that's cool. It's a Monday, so that's nice that the market's not just dumping. I looked at currency strength this morning. The JPY, the Swiss, started off very weak all morning.
Mm-hmm.
Started to rip back up here right at opening bells. Like, okay, like I just think that what you have to watch is you have to watch for risk on versus risk off flows.
Yes.
And so the whole question is, I don't think the Fed is going to get it perfect. I don't think the no landing scenario is really going to happen. I think that I think we're close, man. I think we're so close, right? Like it's not easy for the Fed, but if they go more aggressive on rate cuts, I don't think that's a good thing for the market. I think this will be the first time since, the Fed cuts, it's like it's not going to be a good thing, because if they go more than what's expected, it shows that they are admitting that they're behind the curve. They are admitting that
I agree.
they're wrong. And all of a sudden the market's going to take that and I think punish it.
There's one caveat, Chris. You ready for this? This is another thought. I listened to the super permeable Tom Lee came on CNBC. I don't know if you saw that segment from him.
I did not.
He made an interesting point, which was the only way that a 50 basis point cut would be a very positive thing would be if it was accompanied with the Fed disclaiming, maybe in Jackson Hole, maybe in their next thing, if they disclaimed that we are slightly deviating, if they seem like they're deviating from their data dependency thing, which was his whole point, was they need to deviate from the data dependency thing because that's going to lead us to only fixing things once they break right now.
Right.
Tom Lee was pointing out that for, there's a lot of signs that that he sees and many others that, inflation seems to be cooling. We've seen unemployment rate rising. They need to stop being data dependent and lead this a little bit. And if they came out and said, something along those lines, that they're more going to be leading it, there's risk there. But then a 50 basis point, if they came out and slapped a 50 basis point strong on there, maybe in that case where they say we're trying to, we're going to stay confidently ahead of this. We think we are ahead of it. We're just going to go ahead and do this. That's the one case that he made that would be 50 basis points would be super bullish for the market. But I agree with you in the sense that if they just kind of, cautiously puts into the meeting and they say, yeah, we're going to do 50 basis point, I would agree. That would be more, if they're just saying we're waiting for data dependent, and then they say on a data dependency, we're cutting 50 basis points, that's going to creep the market out. But if they say we're not data dependent and we're cutting 50 basis points, or they are data, you see what I'm saying? If they try and lead a little bit, it could be positive. If they lag and they say 50, it's not going to be as positive.
Yeah. But do you see the Fed actually coming out and being that like forthcoming?
I
And
don't.
I don't either. So it's like they've never done that. They've never done that. It's like for 2 years we've heard data dependency, so
Yes.
why would they change it and pivot to be like, well, we're gonna spin the words on why we're gonna cut 50 basis points? It's like
Yeah.
they've never done it. And so I just think it.
Well,
I think
the last time I can think that there was something of that nature was in 2020 when Powell got, attacked for saying it's transitory.
Oh,
That was
yeah.
him trying to lead,
For
what was
sure.
going to happen. And
the next big FOMC meeting, he completely backpedaled on that
yeah,
transitory
totally
comment.
erased his opinion on it. Said we're going to stay data dependent. And then we started hearing that every time. So
Exactly.
it's tricky, man. I don't, I would love to see a 1995 scenario where we see, they thread the needle and things come through. But historically speaking, it's all about whether or not we enter a recession, right? If rate cuts are
Agreed.
accompanied with a recession or not a recession is two different stories. Everybody's so fixated on once they start cutting rates, short the market with everything you got. And it's not about the rate cuts, guys. It's about the state of the economy when rate cuts begin. That there's a distinction there, because if you go back, we've talked about it 100 times on the show, 1995, they started rate cuts while growth was still strong, but inflation was beaten. The market went on a absolute monumental, life-changing, wealth-creating rip to the upside. And so you have to be careful just barking rate cuts are bearish. You have to do a little bit more work than that. And that's what we're trying to do every day on the show. So stick around with us. Chris and I are here every day.
Yeah. And I also think that, going into this next 30 to 60 days, like I'm just going to keep going back to, like, right now, if I go back to 2017, 2018, let's have a brief. So we talked about this last week, but I think this is a good lesson to draw from. I'll go back to this chart here and go back to SPX and go back to 2017. This is the closest thing I can find to what we just experienced last week. And it was the low volatility rip we saw in 2017, and then the volatility event we saw in January of 2018. I'm almost there. Here it is. Okay. So this was a bit of a rip your face off volatility event. That's what ours was on Monday last week. So think about this scenario. What did the Fed do in 2018? They were raising rates in 2018, and they raised rates every quarter through 2018. Now, the market responded to those rate hikes pretty favorably, right? Because we had the vol event in early 2018, and then the market spent the entire year after that dump rebuilding all the way back to all-time highs. Now, the final, October, this is what I'm kind of concerned with moving into the rest of this year. I know we have an election. We didn't have one in 2018. But getting back into, July put in a high, okay? I said maybe a month ago that if Q4 of this year is not bullish, I'm way more concerned about going into 2025. If we don't come out of Q4 with a bullish tilt or a bullish posture, I'm way more concerned with where the U.S. market's going to be. Now, I will say this, Nick, is it easy to be a short seller in the market? Is it easy? Is it easy to sell and be a bear and make money in these markets? Yes or no?
I've been short since 2016. How am I doing? No, it's not easy. It's like the hardest trade, especially for my style, Chris, not to stop your point, but I like to trail stops. Shorting is terrible for, unless you are just ratcheting stops so tight. My strategy is much more favorable to grinding uptrends where I can trail stops within there. But keep going with your point. Yes, it's hard to short.
Yeah. So even if we were to go into, you look at COVID, you look at 2022, you look at 2018, it's like even 2018, when this was clearly some damage was done here, right? We have this big drop, and then the bears keep trying, and then the market dumps at the end of the year. Now, even that, it's like, okay, so we drop, and then we rip, and then we drop, and then we rip, and then we drop, and then we rip. That is incredibly difficult. And believe me, there are tons of people that are seeing this and they're like, I'm so short. And then they get chopped around for like 2 more months before the market actually does what they think it's going to do. And some traders, most traders probably don't actually hold on to those positions. If they're trading options or trading futures, they're going back and forth for 2 months and they don't get any direction that they want. And then eventually they get what they want. But what happens right after that? Boom. To the upside, to all-time highs again. It's like, I'm just telling you, if you play some defense And just look at it this way. If the S&P is down 10, 20, 30, 40, 50, if you got the dry powder, just buy it at all those levels.
Yes.
And who cares about the short term? Who cares about the short term?
But to your point, Chris, I'll just show you this just to add on to this. So I can speak from personal experience in 2022. I know you said you actually had a positive year. 2022 was a negative year for me. I lost a lot of money in 2022. I mean, I made it all back and things were fine. And I'll get to what you just said about dollar cost averaging, which absolutely was my strength in 2022, but it was a negative year for me. And during that time, I had in this market, you might say, how could you mess up on the short side? Well, I did. I messed up on the short side, even in this market, because to your point, the thing about these markets is that when, if you're talking about the NASDAQ, I'm not talking for the currency traders out there, for gold, for things that are not, just like kind of built to go up over time as the indices. This year for the NASDAQ in 2022 was so difficult because even when you would get these big squeezes low, these moves to the upside were so violent. Look at that low to the high. That's a 10% rip in like 3 days. So you're talking about even in a bear market, you want to talk about the most bullish times ever, the bullish couple day periods, it always happens in a bear market. Some of the biggest
2008, those 1 day moves are always in like terrible markets.
Yes. So the point is, to your question about being short, is that easy? I tried during that year and made some mistakes without thoroughly, this was a mistake that I made, was without thoroughly back testing my strategy in a bear market to short stuff. I've tested it many times in bull markets. It works very well. Even in bear markets, I can survive. I'll take losses, but then be able to try and bounce back. Trying to short during that year was really tricky. And I think I lost more money than I made money on the short side, even though the market went down, down, down. The point is, even in bear markets, it doesn't go straight down for a suspended period of time. It usually goes, down and then violent up and then violent down and violent up. It's just violence in both directions. So you got to be real careful.
I wanted to share an interesting setup with you. So Nick jumped off the session, but he was talking about, different strategies, different ways to trade. So I wanted to talk about, one particular trade that I've got running right now. I've got it on the Russell. I've got it on the NASDAQ. I've got it on the S&P. I have it on gold. I have it on silver. I'm thinking about doing it on copper if I can get the right prices for it. I did it on crude oil. So I like the strategy enough to throw out all those symbols, and I'm doing this type of strategy on it. And it does a couple things for me. It basically gives me levels that I would say I'm willing to own this asset at this price. I'm willing to, have a hedge in case things get really bad. And I'm also willing to have a bit of a bear trap in case I get paid and get like an extra profit. So it's a credit trade, so I can collect money up front and keep it through expiration. There's an extra gravy side of that, where if I get the market to be a little bit down, I get a bit of a profit trap. And then I can also use options and still roll, and I can, keep things somewhat tight. So there's pros and cons with everything. It's not some foolproof trade. But I don't, nobody knows this, but I don't think that if we have let's say we go into a bear market, okay? Do you think a bear market is going to look like what we just saw, Thursday, Friday, Monday? Is it going to look like that over and over and over again? Or is the bear market going to be more like, 2022, maybe a fallback in 2018? I mean, unless we're having 2008 all over again, which I don't think we're at 2008 again, but thoughts on that?
I think that I still have this idea that, okay, we tested the 200 day on the NASDAQ. We got close with the S&P.
Yep.
I think if that sort of angle is broken, then yeah, we could have another wave of this. I don't think it's going to be one after the next, like for an entire year or something.
Right.
But I think, yeah, if we're in a bear market, we're not going to see a crash every single day. We're probably just going to keep trending lower and making lower highs over time. Will it be this aggressive? I'm not necessarily sure. However, if we do break under that 200 day, which I think this week is very pivotal in that, because we already have that cooling jobs data.
Yep.
And I know that we're highly sensitive to that now.
Mm-hmm.
But if inflation is lower, or if inflation is higher, that's showing we have a cracked jobs market. Unemployment claims isn't enough to to counteract the 4.3% unemployment rate. So we see cracked labor market, and then we see stubborn inflation or higher inflation. That's a very bad sign for the market. And I
That
think
brings back the stagflation conversation, right?
right, and I
Yep.
think that's going to be pretty pivotal this week. So if inflation kind of ticks lower like it has been, I think more focus on the jobs data. But if inflation stays where it's at or goes higher, then it's that question of that Fed emergency rate cut and stagflation and putting us in that bearish scenario again. So a 50 basis point cut is not like a good idea in my opinion, but I don't think it's not necessarily about what I want. I think that just might what they do. And that is likely going to cause some relief, but it's not going to help out the economy long term, because now we're putting ourselves back up in harsh inflation threat territory. And then we can't promise that the jobs market's going to be saved anyways based off this cut, because a 50 basis point cut is not that much anyways. So I'm not really I'm very cautiously bullish. I have a call vertical for the end of the week. It's only a couple points. So if we go up to, I think, 457 on the Qs, I'd be I'm hedging. So I'm doing the same thing as last week with like 1 or 2 contracts, buying puts way out of the money, very short term.
Okay.
I'll lose on most likely because they'll expire worthless, but we get another move like we did the last couple days in the last week, then they'll change drastically, probably end up making a lot of money off that. So
okay,
I'm at now.
So I wanted to look at let me actually price one out right now. I do think we're going to get a fair amount of volatility. I just want to see what the prices are. If I look at like right in here, this is kind of that nice equilibrium point. I think this is perfect to see, a bear side move that, let's go back down to 420. That's a $33 move. And then to the upside, if we really, the Qs closed up above 475 or 480, that'd be a 20. So I'm going to do what I do typically with an earnings play, and I'll look at the Qs, I'll look at the SPY. Qs are going to be a little bit more sensitive, but I think I'll look at both, dude. Let's price something out. So we're kind of right in this equilibrium, right? I could see us getting to this level here. I would like to see a retest of, I don't want to see a retest of lows, but it would make sense to me that we have such an aggressive flush down. We come back and we allow, big money in market movers to just basically get out of crappy positions. Like anybody that was caught off guard with this probably spent all last week, and I'm including myself here, all of last week just playing defense. Like I've got more hedges in, I've got more defense in. I took a stop loss this morning on my NQ because it blew through my stop loss last week because of the volatility squeeze. So I did get stopped out on my NQ for just this put at 17,000, but I still have a bear trap in here at 19.1. So if we stay below 19.1 for the next couple of weeks, and there's no expiration on it until the 23rd and the 30th. So if we stay here, that's a $5,000 profit for me, and I only lost about $2,000 on this position. So I'll make profit on that trade. But point is, let me price something out. If we look at current prices on the SPY, and number one, I want to see what the calculated expected move is. So let's go trade. I think right now I have to be ready to trade this through probably the end of September. So I don't want to be super short term. It's going to be a trade that looks like this on a risk graph. So it's going to be there's max profit because I'm going to sell. There's going to be a trap here. Okay, so this is about what my trade is going to look like from risk. So if we go up, I can make some money. If we go down, I can make some money. And then if we go nowhere, I just want to see what that debit's going to be. So this is going to be reverse iron condor. I'm hoping that I can make, at least a 1-to-1. If I'm willing to risk, let's say $1,000, then I've got to be able to make $1,000 on the other side with a slight probability that we can go, up to this level or down to this level and give me something to trade here in the next, maybe 30 to 45 days. So
wait, so is that you're saying you're doing that as well? Is a bear trap not keeping it I guess you're hoping price doesn't go above a certain level, right?
Correct. So this trade is the trade that I did here. So this trade it's all puts, and I did it this way. There. That's what that trade looks like. So I collected like $20 credit here. Okay, and then I have a bear trap that pays me about $100 credit because it'd be 100 points wide on the 19.2 by 19.1, and then I have risk all the way down to this was if we go beyond, that's 17,000. So this would have to be, we'd have to go below like 16. We'll say 16,950, something like that.
When does it expire?
August 30th.
Okay.
So if it stays where it is, like right now, this is perfect because I took a small loss on this side, but I have an out of the money naked put that's still running. So if we have another flush lower, my out of the money put can maybe pay some bonus money there. This trade would be full profit. I took a loss here of about 2K. This is worth 5K, and then this trade cost me like $300, and it might pay me a couple $1,000. So there's a way that I can make this trade work if we stay below 19.1.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.